Well, good afternoon, investors. Welcome to the November 16th bull session. My name is Mark Robertson. I'm joined here by Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody.
Hi, guys.
Glad to be with you.
Hi, guys. Good to be here.
And Kim confessed before we got started in the green room that she's scaling back on Christmas a little bit in cooperation and with her mother, but she's apparently ahead of most of us. And Ken has already been out shopping, so I'm feeling a little guilty as we get started here today. Not too guilty. Don't worry about me or anything. All right.
You just told us your address where to send presents. Is that all?
Oh, I can make a slide up for next week if that's helpful to anybody out there.
Sure.
All right. So this week we are approaching Thanksgiving. We are approximately 40 days from Christmas. For those who are out there who need a reminder, we are going to talk about at least one of our red rabbits gone bad here this afternoon, and not really bad, but bad enough to get our attention. And then we're looking for a replacement. We will spend some time talking about investing with friends. We did make it possible for people who want to invest right alongside us with the best small companies. Then I want to spend a few minutes talking about Armour Up, and that's basically a little bit deeper dive. I think it's probably going to be one of a series of a multitude of stocks where we basically show that Kathy Wood and her S curves and Brian Feraldi's stuff is more than just theory. And we're going to visit Under Armour here today. And then a neat little graphic on EV dominance. Any overall thoughts you want to share, Ken?
No, but I have people in the audience suggesting that we use Venmo to send you money. So, you know.
I'll make up a slide with my wife's Venmo address on it.
Okay, all right.
But I'm not sure I'll ever see that. All right. Here's the legal stuff before I get into any more trouble on the family front. No investment recommendation is intended. This is an educational demonstration. Everything we do here is to basically put on display and to illustrate and to demonstrate the philosophies, methods, techniques, etc. of the modern investment club movement. When we talk about stuff, we're expressing opinions, our own interpretations. We are attempting to share lessons from over 8 decades of doing this stuff. Not us personally, but you can date back the modern investment club movement to about 1940. And please do your own homework and when making decisions. If we hold stocks or shares in the companies that we're talking about, we try to disclose that. Don't always remember, but we generally do. We do have a monthly webcast referred to as the Roundtable. If you'd like to receive a reminder about when that is so that you can attend it, please send an email to nkavula1@comcast.net. And then if you want copies of the slides or if you have follow-up questions or suggestions, Ken and my email addresses are there at the bottom of the screen. All right, so let's roll. All right, here's kind of our standing agenda. And Ken, I really wanted to get to inflation jitters this week with all the stuff in the news. I just didn't have time. I was having too much fun doing some other stuff.
Well, let's definitely try to address it at the next bull session, Mark. I have a couple of ideas, and some of them are, I think, maybe will prove to be interesting conversation points.
I think it is a conversation with merit right now, especially with all the stuff flying around. I just have so much stuff collected up that it's going to take me a little bit of time to go through some of that stuff. So that topic, in addition to others that you see here, we will be covering in greater detail. And please, you are invited to make suggestions with respect to that. Today, we are going to talk about the best small company portfolio for next year. Most of you already know that we have turned it into what has always been a passive portfolio where we retain and hold the stocks from Halloween to Halloween for the last several years. This year we added an actively managed component to it, and we'll be talking about that today. That actively managed component is taken care of at M1 Financial, so we'll be demonstrating a little bit with that. And then I do want to start this. I think it'll actually erupt into a series of taking a look at some of these companies and this S-curve theory. Anything you'd like to add at this point?
No, it's a full agenda for this afternoon, so we should get started.
All right. I just found this graphic. It comes from Visual Capitalist to be kind of fun. We live here in the middle of the big three with GM, Ford, and Stellantis. And this is basically a summary of what is going on in the electric car world in visualizing the race. Now, obviously, Tesla has been out in front of that for quite some time, and it's been going pretty well for them. I mean, they seem to be only constrained by their production capacity, but other companies are getting serious about it. And the following graphic actually shows, kind of a look at the playing field, and it's quite the horse race. And that doesn't include Rivian on this chart yet, a company which is now worth over $100 billion when you total up their market capitalization. And I think, Ken, they are under $1 million in sales or something like that. I mean, it's
way under $1 million in sales. Something like 20 vehicles so far that have actually been produced, Mark, and most of those are being driven by management and staff.
Yeah.
So it doesn't have very much in the way of sales at all. But on the other side of that coin, it is a group of very experienced people in automotive technology and in the automotive industry. And so people are not discounting its chances of succeeding because of all the expertise they have in the management side of the business. We should also make the point that that last bar over to the left represents Ford Motor Company, and Ford has a sizable stake in Rivian. So whenever Rivian's going to do real well, Ford will be taking, about 10 or 11% of that belongs to Ford Motor Company. Now, whether that will continue, obviously, is up to the Ford Board of Directors. But at the moment, Ford is betting that Rivian is going to succeed and succeed pretty well.
Yeah, and I'm hearing a lot of pretty favorable feedback on the efforts of Nissan, and I'm not even sure that's reflected on here. Nissan, and then Toyota obviously has been out there for quite a bit, but it's quite the horse race, and it'll be interesting to see how this stuff begins to unfold. And we have promised to take a closer look at we're probably a little late to the party in the case of some of this stuff, but where are the investment opportunities now? Something we probably do need to take a closer look at.
Mark, you mentioned General Motors and Ford in Michigan here, but you mentioned a third company that some people in our audience aren't familiar with. I'll bet you they're familiar with Dodge, Chrysler, Jeep, Ram, Fiat. I've missed a couple of the other brands, but it's the old Chrysler Dodge company, which is now operating under a brand new name. And it's gone through quite a few different names in the last 15 or 18 years. So there are marks pointing to it right now. Give us the name of that new company again, Mark. It's not coming to my head.
Stellantis.
Stellantis, okay.
And we live within a stone's throw of Stellantis. My wife works there, and we've had to change the highway signs several times in the last 10 years. They actually own their own roads. So it's been quite a run.
It's not a household word by any chance, but the brands are well-known brands that are under that particular canopy name right now.
Yeah, and they are very interested in maintaining their Jeep dominance. The interesting thing about Rivian is they're not going to attempt to make cars. It's going to be trucks and cargo vans and sports utility vehicles, and they're not going to go beyond that, at least not at this point in time, is my understanding, Ken.
Well, isn't the big positive right now that huge order that they have that Amazon placed for delivery vans?
Yes, and there's a couple different versions of that story out there. I do not know the intimate details, but there are a couple large orders out there impacting this market right now. All right, I just thought the graphic was kind of cool. Speaking of cool graphics, I'll let Ken tell you how cool this one is.
Well, this is the groundhog contest, started back last February, so it has a good 8 months under its belt right now, maybe a little bit more than 8 months, and you can see one of our faithful in the bull sessions at number 7 up there is Len Douglas. I'm coming in at number 11, and number 12 and 15 and 29 are 3 of the clubs that I belong to. So I'm just sailing high and feeling really good about the contest this year. This is not something that's normal for me. I'm normally mired down around 104, somewhere like that on the list. I see Herb Lemkohl, who's another one of our faithful in the bull session, sitting there at number 30. So it's been a tough year to beat the market. We only have about a quarter of the entrants beating the market, 37 of 144. And we're not picking on Kathy Wood, but it's interesting to see where her choices rank versus the choices of a lot of amateurs. And basically, if she were in the groundhog contest as an entrant, she'd be down around 138th out of 144. Average return, 11%. The market's average return, that's that one in yellow down there, about 22%. So you can see that it's rough. And if you're going to beat the index, then you're really doing quite well. And we have a lot of 30s and 40s up near the top there. That's great for anybody, whoever's doing the picking. And frankly, if you've returned 18, 20% in this market, I would not beat yourself up for it at all.
I just wanted to point out that the clubs or the groups are bolded, and several of those are Kavulas or Lemkohls, but the clubs are definitely coming for the individuals. The clubs have been bubbling up the list a little bit here recently. All right, on to our Ken. We've got work to do. We talked about this last week and just admitted that we seem to have a problem with eHealth and eHealth.
Oh, and we had a real honest discussion about eHealth, Mark, when we even put it on the list. There was some back and forth about whether it belonged on the list, and we decided finally that as a turnaround, it might be an interesting company to put on here as a turnaround. Maybe we should have chosen Emergent Bioscience as a turnaround instead of eHealth, however, from what's been happening.
Yeah, it's a tough one. I still really like the theme behind eHealth, but it's definitely a jungle out there in that realm, and that's what Matt Spielman and Ken talked about during the selection process. Again, I kind of feel like we're the parents who the child brings home the report card and it's got 19 A's on it, or maybe 17 A's, 2 B's, and one that's below a C, and the parents are immediately drawn to the one below a C. That's not trying to deflect how I feel about eHealth. We definitely have to be honest about it, but boy, look at those numbers up at the top. I wish we didn't have eHealth in here. It's kind of holding us back a bit, but can't complain. It adds up to a pretty good result so far, but we do need to go to work, Ken, and I do think I'm going to give you one more red card next year.
Okay, great. And I want to assure the audience that we're going to maintain this portfolio, including eHealth, and we're going to follow it through to the end, through next Halloween. So the passive portfolio will not go away, and we'll report on it occasionally to let you know how the passive portfolio is doing. But right up beside it now, we're also going to start demonstrating what might happen if we did a little bit of active management of that portfolio. And this is the first active management step we're going to take. We've already moved eHealth out of the portfolio as of the 9th of November. and now we're going to put something in its place.
Okay, and here's just a reminder of how nasty that 2021 most recent report is. What you're looking at here, again, is just a real vivid reminder that when you're dealing in this realm of companies, that if you're dealing with a company that has broken through and gone positive on the earnings side and they dip back down and go negative, they generally get crushed by the investing world. And these guys are certainly not immune to that. And that is what is actually happening right now. They are getting, I'm pretty sure the stock is down another 10% from where we basically pulled the relative return trigger on it. It went, by the way, it went straight from -8 to -34. We didn't have a chance to stop at -20. So it actually blew through our -20 trigger point. All right.
That's a -20 relative to the market, folks.
Yeah, that's this number right here. So -20 relative to the market. So while the market went up 2%, it's gone down 32. Therefore, it's down 34 relative to the market. All right. Anything else you want to add to that, Ken?
No, but maybe we should think about emergent bioscience, Mark. Maybe we should add it to the pile as a possibility for our 20th. Or aren't you brave enough to do that?
Well, now it's gone up. Len already told us it's gone up from the mid-20s to over 40. So our opportunity may have actually sidestepped us a little bit. I don't know.
Yeah, moved right through us, huh? Okay, well, let's look at some of the... Go on.
I'll keep it on the short list, but whoa.
Okay. Well, let's look at some of the other candidates then, okay?
All right. We actually only have a couple that we ended up with today that seem to be reasonable to consider. And the first one is actually a repeat. It was on the best small companies list 2 years ago. It actually came in at a 21% better than the market for 2 years ago on the best small company list. So it would be a returning company. And haven't had a chance to refresh my memory too much about it, but what we're basically looking at is a relatively small company, $500,000 in sales, growing at 19%. That's the red line, the red trend line. So growing at 19% with projected profitability in terms of net margin in that 30% range. That seems like a kind of a reasonable thing if these guys continue to fire on all cylinders. So that kind of checks out a bit. It's not an exorbitant PE ratio. And the number is pretty far up there. The projected return is at 36%. Interestingly enough, they have more cash than liabilities, which is not normal. Not something that you frequently encounter with companies in this realm of life cycle. So their projected return on value is actually 24%. That kind of attracts our interest. Well, little long-term debt that they actually have, because keep in mind, they've got 2 times that in their checkbook. Checks in at less than 5% on an effective interest rate. So there's just quite a bit to like, in addition to what the analysts are expecting revenue-wise for this year and the next 2 years. And then notice the profitability expectations down at the bottom. So pretty interesting picture. How would you summarize the company?
I want to make one more point on those graphs, Mark.
Okay.
This point where companies become profitable and where we're just starting to see emerging positive profit numbers is one of the few times in the life cycle where the company can kind of change its direction as far as earnings per share growth or sales growth is concerned. And this company especially is projected by some of the data sources that we're looking at, is projected to grow sales upwards of 30% for the next 2 or 3 years. So we usually tell people, you can't really project sales any faster than they've been growing in the past. But this company being at the cusp of this ramp of accelerating growth, you might be able to expect sales to grow even quicker than that 19% trend that's going on right there. So that's a real positive, in my mind at least, for why I would like to take a chance at this company. Now, unfortunately, we also have an equal chance, so I'll put a small yellow card out there on the table. We also have an equal chance of it falling back into being non-profitable. Its last quarter was considerably down from the second quarter of the fiscal year, and the people that are supposed to know about this, the analysts, are telling us that the fourth quarter will be kind of level with the third quarter, and then the sales growth will take off and really move up there in a very dramatic kind of way, and the earnings will then follow. But with all that being said, I can't see anything wrong with the analysis at the moment. I'm just, I guess, putting a yellow card out there that the rule of 5 is still in play.
Yeah, and one other thing we should probably point out on this slide, Ken, is when the company goes positive and then turns around and reverses course, you get this, which is basically these low prices.
Yep.
So it happens time in and time out. So it's just something to be aware of. How would you best summarize the company, Ken?
Using non-opioids to manage pain. And it can be pain from an arthritic knee. It can be pain that would come from an operation. This would include various types of non-opioid anesthetics that can be used within the operating room. But it's just a whole array of non-opioid pain management, and then also looking for drugs that will help regenerate various parts of the body and take away whatever happens to be causing the pain. So all in all, it's a fairly simple mission statement. Now, obviously, getting to that point requires a lot of testing, a lot of phase trials. Some of these things have to be approved. Most of these things have to be approved by the FDA. So it's a long process, but this company does have product that it's selling and making money from right now.
Yeah, and Ken actually did also point out that they have a lawsuit filed by a group of anesthesiologists, I believe.
Yeah, the American Association of Anesthesiologists, right.
Well,
no, the lawsuit is filed by the company against the association, right?
Yeah, because this group, this number of people are basically saying that the product doesn't work as well as they think it does, and so it's not a pristine situation for sure. And then we got kind of a kick out of this slide because I don't remember the last time I've seen a slide. This is off of their Investor Day presentation. You can reach that at the bottom of the thing. But check out the chart they've shared with us. This ranks right up there with no worries. Just have a good time. So
yeah,
let's hope they're right.
I would ask myself if you don't get into real trouble when you project growth that steady and at that higher rate. Now, maybe they get away from it, Mark, by not putting any scales on the graph. I mean, that line for revenue looks pretty steep, but maybe it's not as steep as it looks if you put a scale on it. I don't know. But a company willing to project 7, 8, 9 years into the future, that's a real rare breed, and I'm not sure how you really can tell very much past 2023, maybe 2024, as you're looking at this graph.
And at this point in the presentation, I need everybody to raise their right hand, because if we take a stake in this company, you can't turn them into the SEC. Everybody has to promise that they won't do that. Okay, well, the lower box on the right is kind of what piques my attention about a lot of companies in this realm. The fact that Chris Jenner of Rock Springs Capital Management is on the ownership list, along with Deerfield and a couple others, a couple that Kim mentions from time to time. I don't know much about Tamarack. I know a lot about Paulson, but these are some pretty interesting firms. The one up at the top that's mentioned first is Renaissance Technologies. That's Jim Simon's firm, and their holding period is about as long as between breakfast and lunch. So I'm not sure that means much. But the rest of them are pretty committed and convicted long-term holders.
I think an interesting topic for a future bull session, Mark, might be to spend 3 or 4 slides looking at Insider Monkey itself, looking at that website and coming up, showing how we can come up with this kind of research from Insider Monkey. It's a pretty interesting site that I don't think a lot of our participants, a lot of our attendees know very much about.
Yeah, we can do that. Go ahead, Kim.
Yeah, I have one that I think's even better personally. Everybody out there, it's called Data, D-A-T-A, Roma, R-O-M-A. It's all the super investors, and you can see, because they have all the 13F filings of all the super investors and what they've bought and sold in the last quarter. It is my go-to.
Yep, we'll take a look at both of those. Maybe we can get you to lead a brief discussion on that, Kim.
Okay, sounds good.
I'll add it to the queue. So again, I'm liking kind of what I see. It is a repeat company from the past. So I propose that we go ahead and turn this into position number 20 for the best small company portfolio. You okay with that, Kim?
I will tell you, Mark, that Matt Spillman is giving us a gentle push, telling us that the PE, even with all of the movement, the PE for emergent bioscience is still under 10 today. So Matt's giving us just a gentle push in the other direction there. So, and we know what a good stock picker Matt happens to be.
Yeah,
so,
he's just making our life more difficult.
We're going to give you the opportunity for a great big "I told you so," Matt, at the end of the year. Okay.
There you go. All right, one company that is on our short list that we're not going to go with today, but it probably merits a little further study, is a company that was on our short list as we built the list, National Energy Services. And this one is right up the alley of recognizing the reality that no matter what happens with our vehicles, we're still going to need some other stuff like heating our homes and plastics. So somehow that all plays into this, and could probably even look at political ramifications a little bit. But interesting company. As Ken pointed out, they're headquartered in the British Virgin Islands, which leads to some confusing stuff as you start to do research. Be careful out there. I'm pretty sure they are headquartered domestically in Texas, but we do want to dig into it a little bit closer. Obviously, the graphs are pretty. They're short.
Yeah, I did find some confusion, Mark, when I did some investigation of their finances and everything. I did find some confusion where, depending on what source I was using, I happened to be in 2 different currencies. And when you think you're all in the same currency and you're really not in the same currency, that can really play havoc with your investigation. So I think you need to be real careful that the data that you're looking at is all in the same currency, whether it's American dollars or whatever currency is used in the British Virgin Islands. I would assume, but that's just an assumption, that being a British territory, it would be using the pound, but I don't know that for certain either.
Yeah, it can create some substantial confusion. So it's something you want to always be watching for. And the last point I'll make is that there are reports of nearly $5 a gallon gasoline in California. So that whole turf has transformed pretty dramatically for companies that produce stuff into that. All right, so we'll go ahead and do that. Just a moment talking about investing with friends. Again, in response to what you guys have asked for the last couple of years, we did go out looking for a portfolio-based company. There used to be a handful of these, and many of them fallen by the wayside, including companies like Folio. But M1 Finance is still out there. I've been pretty impressed with my transactions with them. Still learning my way through operating the system, but it is a site that has enabled us to place the 20 companies and invest real money in it, and you can actually follow along with your own personal portfolios. So it is at m1finance.com. And I would encourage you, if you're considering tinkering with this, they have what they refer to as investment pies. You would probably recognize as a basket of stocks or funds. And it's not for traders. It's not for people who completely obsess over their purchase price and that sort of thing. These guys do the window purchase of a batch once a day. So again, it's not for traders. It's best for a passive investor, which generally applies to most of us. Do-it-yourselfers are obviously in pretty good shape here too, and the cost is right. No transaction fees. The other considerations that you might have for opening an account would be that they do not do traditional mutual funds. So just be aware of that going in. But all the other aspects of it seem pretty favorable, and so far I'm getting pretty good feedback. Nick DiVirgilio reported that on a sale, he got a partial sale when he expected a full sale, and I think that might be related to the technique of selling the position. And that's something we'll talk about as I understand it better myself. Basically, if you eliminate the slice of the pie, it sells the whole thing. If you attempt to tell them how much to sell, you can get into a situation where you sell everything but the last 10 cents of a position, that sort of thing. So that is out there. So what we have done is we have placed the best small companies on M1 Finance. You can see the link right there. If you go to it, you can actually see the best small company portfolio, and you can invest in that pie. Now, full disclosure, we do receive an incentive, and so do you. So, for example, $10,000 would result in the return of $150 to you as an investor. Manifest Investing would also receive that $150. It goes down to about $30 if it's a $1,000 account creation. So here are the 20 companies that are in the portfolio. We already have taken eHealth out. We will be replacing it with Pachira. Any comments or questions from the audience, Ken?
I'm trying to keep up right here, Mark, but I think we're pretty set.
We are going to be talking a little bit more about this one. Don't want to do it today, but we do have the opportunity to create some other portfolios. This is one that I've always been interested in, basically trying to provide an investable emulation of the value line, all of the above arithmetic average. And this is an attempt to look at it. We'll probably put some real money in it and see how it tracks the value line arithmetic average. The appeal here is it's dirt simple. It's our 25, 50, 25 distribution of companies, in this case by market cap, but not going to obsess too much over that stuff right now. But you are looking at an investment, if you could have invested in it over the years, of approximately a 15% annualized return over the last 5 years. And that's pretty compelling for a passive investment option. Any thoughts you want to add to that, Ken?
Well, the only thing I want to add, Mark, and we're getting a lot of comments rather than questions, these pies have names. And if you're doing some searching for these pies, you do need the full name. And I think the parenthetical expressions are part of the name. Am I correct, Mark?
I don't know for sure, but I suspect yes.
Okay, so that means that the small companies includes in parentheses 2022, and the all of the above pie includes in parentheses values-based line. So I think if you're going to be searching for these specific pies, if you're going to do that by name at least, you need the, that's answering a couple of questions, but right. I think you need the full name.
Yeah, and this link down at the bottom actually takes you to this all of the above portfolio. And this link here will take you straight to the best small company.
Right, so it's better to use the code rather than try to reach it by name. Okay.
Yeah, and that makes sure that you'll get your incentive, and so would we, because that's the way they track that sort of thing. Anything else at this point?
No, let's keep going.
Okay, and I'm going to come back at you on that medium-sized company thing that I've now heard from 3 people about. So we'll be talking about that. All right, let's have a little session on another one of these life cycle considerations. Again, the overarching theme is this is not just theory. It's not just theory. It's a representation of what happens to companies as they go through their life cycles. This is that break-even tipping point that Ken and I have been talking about for the last several minutes. So it's all there in black and white or black and gold or whatever that is. All right.
And Mark, I mean that graph says there's a single break-even point, but it's not uncommon, we're finding, for these smaller companies to have at least one dip back into the negative, and sometimes 2 or even 3 dips before they finally move into profitability and stay there. So that can be a little bit of a rocky road right around the crossing of that line from no profit to actual profits.
Yeah, and for those of you that haven't actually absorbed this lesson from Brian Feraldi, again, he's affiliated with the Motley Fool, kind of an advocate or a disciple of David Gardner. And he basically goes through and talks about, yeah, he gets all the stuff. He invests just like we do when it comes to the companies down the middle of the chart. But there is that whole class of companies out there where PE ratios don't work. And it's one that drives many of us crazy over the years. And that's what we're going to be talking about here in a minute. We have solved that in the past with the price to cash flow ratio implementation. That can get a little bit complicated. But there is that class of companies. How do you decide that it's a meritorious consideration when it's somewhere over in here? And Ken even has been talking about some companies that are over here recently.
One company.
kind of worried about him when you don't have sales or earnings on your visual analysis, Ken. I think maybe an alien is taking over your body.
Could be. I think the graphics really good, Mark, at showing that point that I was making before also, that usually projecting future revenues at a higher rate than historical is a very dangerous thing to do. But in these companies that are just becoming profitable, that in fact is more the norm than anything else. You see good, consistent growth prior to becoming profitable, and then sometime around profitability becoming positive, you also see revenues change to the higher side. Everywhere else on the graph, when they're changing to the lower side from history. But there's that one place on the graph right there where the inflection is to the higher side of growth, and that's where we'd like to catch that company if possible.
Okay, I'm starting to feel like the attorneys in Kenosha. The jury's tired of hearing this time and time again. If this stuff is new to you, go to that. Just do a Google search on "Good Reasons to Ignore Valuation" by Brian Feraldi. You'll find it. All right. Let's talk a little bit about Under Armour. Under Armour, and a question received nearly 14 years ago in our forum. And I have to confess, I feel a little bit guilty with some of the answers, especially that were given to younger people back in that time frame, because it can be tough for investors to invest in early stage companies. I have probably dozens of stories I could tell about this type of a situation, but this is one that I recall basically talking somebody out of an interest in Under Armour back at that time frame. And the question was specifically, seemed to be some fairly erratic stuff going on, and that is a characteristic of these type of companies. So let's take a look at the answer and see what have we learned since then, and just take it from there. So again, our analysis of the company, again, fairly early stage company, so there's a lot of volatility in an early stage company. And this was a situation where fairly well into 2008, they had the analysts covering the company had done a fairly significant reduction in expectations. And that's enough to actually deflect or impact the visual analysis and the numbers generated, the return forecast generated for a company like this. So we actually think it's an advantage that we're watching for this sort of thing. It's actually a fairly powerful advantage in our opinion, but it can be quite impactful and hyperactive almost. So that type of volatility, or someone might even think of it as almost an instability, can discourage an investor from a company like this. And so we want to take a little bit closer look at that specific situation and how it ended up. Any thoughts on that, Ken?
Yeah, Mark, can you place this in a little bit more context? Any idea what my par was during this questions time period?
If I had to render a guess, we're probably looking at 10%.
So that 14% that the par had dropped to was still sitting 4 points above average, right?
Probably, yes.
Yeah, and I think one of the best things that we can teach young investors is sometimes to, I don't want to say lower expectations, but I want to see, I guess I do want to say not be quite so optimistic about how much you're going to make and how quickly it's going to happen. And 21% is certainly a great par value. And if you can achieve that over a 5-year period, that's a wonderful thing to have happen. But my first reaction was, well, 14% is not so bad either.
Mm-hmm.
And even if it came down to 14%, would you still be happy with the investment? And I think that's a valuable lesson for beginning investors to take into their head and make decisions about. I think we each are have different levels of greed, and we each have different trigger points, and we each have different patience levels too. And those of us that are really successful long-term investors, I think sometimes maybe have a little bit more patience than folks that are popping in and out and from stock to stock and all over all over the ranch when it comes to what the technique is going to be that you're going to use to pick stocks for sale and for purchase. But my first reaction when I read the question was, don't be as worried as it sounds like you are right now at getting a stock that has a 14% par. I guess that's all I wanted to say.
Yeah. I guess this is also a situation of, let's say the individual invested $100 and it was suddenly $90. That can be quite unsettling.
Absolutely, especially if that $100 is part of a $1,000 portfolio rather than a $100,000 portfolio.
Exactly. So let's dig in and take a little bit closer look. He basically asked, is there any way to understand what's happened? And that's where we encourage. I answered no, but basically if you do a complete study, you can spot, where the change comes from. And in this case, they had actually dropped their expectations for profitability from 9% to 6%. So it's quite a situation. I don't think in this case the individual really missed anything. But what I do regret is, and this is kind of, I'm paraphrasing a little bit, but I had witnessed, our son's football teammates, and he played lacrosse also, and they're all decked out in Under Armour all the time. And that has persisted. Customer loyalty is pretty powerful. And the other thing that I want to place into context is, again, after this company came public and they ramped up to, this is split adjusted over here, so you have to make an adjustment in your head. I think you have to multiply everything by about 8 for all the stock splits. But the stock price dropped from 73 to 20. And a lot of times with a company like this, I can actually go back and show you that Nike had this same exact pattern a few years out of the box. So this is something that is not unusual, and you really have to work hard at keeping it in context. Was Under Armour so sufficiently overpriced to the high side that this was an opportunity to walk away from it forever? Yeah, maybe. But again, the pervasiveness and the ubiquitous nature of this amongst the young people especially, pretty powerful stuff.
Well, and reading charts like this also, Mark, force you to become a little bit of a student of history, at least financial history, because the chart not only tells the story of what happened to Under Armour, but it talks about what's happening in the macro economy as well. I just don't think that that spike down at the beginning of 2008 is company specific. We know what that was, and I think we have to take into account the fact that some of this downward trend was not only happening with Under Armour, it was happening with many, many stocks until we get to 2009, where things start to turn around and become much more positive and much more normal as far as the macro environment's concerned. I mean, we're looking at one of the worst times in the stock market that has existed for the last 100 years since the Great Depression.
Yeah, and it's tough to take. And fast forward 12 years, and oh my gosh, you basically see a repeat opportunity. I can remember sitting around the campfire with a bunch of people talking about how a bunch of people that I know were doing their best to stay fully invested back in March 2020. And, half the people they're saying, oh, you can't be serious. What are you guys, riverboat gamblers or what? So yeah, Ken, you're absolutely right.
Well, and it was I was one of those people trying to stay as fully invested as I could, Mark, and it was because of the lessons that I learned in 2008 and that I had learned previously in 1999 and previous to that in 1987. Yep. If the market's not going to behave the way it has in the past, then I'm not sure that anything is going to save me. But I'm going to bank on the idea that the market will recover. I don't know how long it's going to take to recover. I can't specifically say on each specific stock, but banking on the fact that it's going to recover allows me to have confidence to stay fully invested when the bottom falls out like it did in 2008 and again in 2019-20.
Absolutely. So here's a look at the visual analysis from this company, and I think it makes the point fairly strongly that you all, especially with a retailer, you have to be on the lookout for a plateauing, for sure. And what you're looking at here actually shows a bit of a shift, and then there was that kind of a downshift in the earnings expectations for 8 and 9. Some of it related to overall economic conditions, but this was definitely happening at the company. And I find it kind of fascinating. I did not doctor the slides at all. We talked about a company going from 9% net margins to 6% net margins. And you'll see why I'm patting myself on the back here in a minute. But just being mindful of those conditions. So let's take a look at the company. And this is one of my favorite slides already, Ken, that it basically makes the point that this stuff is not all theory. So you're looking at actual numbers here for Under Armour, talking about a company that definitely went through that stage of explosive growth for 2006 all the way up to 2016. And then I find it hard to call that anything else but a downshift. I mean, that's almost 4 on the floor shifting gear, isn't it, Ken?
Well, not only that, Mark, but we put pictures like this in our beginners materials when we talk about companies moving from faster growth to slower growth, and we label them small, medium, large. We can see it happening in company after company, and that graphic that we've been using to talk about PEs is so similar to the life cycle of a company graphic that Better Investing's been using for almost 50 years, that essentially shows the same kind of thing, that companies will slow in growth as they get larger. You should expect that to happen. And if you're expecting that to happen, then when it starts to happen, you don't become quite as concerned.
Yeah, it either enables you to continue holding or to perhaps trim your position or whatever. The point is, for a company that has the retail characteristics of a company like this is going to happen at some point in time.
Absolutely.
I don't know that it's always this stark, but here's the situation looking at on the top chart there, the stock price over the longer term. Here's that episode back in 2008 where we started with it. And then notice as the downshift hits, what happens in the market when it comes to institutional investors, etc. Here's your 2020 market incident also. But I mean, you basically see an S curve. This is earnings down here, earnings on a non-log chart, because there's a negative point out here, then there's another one down here. Again, underscoring what happens when companies go negative. It's basically laid out right there. Do I think that they're going to explode off the top of that chart? No, I think they're going to do something closer to that red line. Don't know that, but that would be my instinct. The red dotted line in the bottom. But again, notice what actually happened with the stock price. That's no accident. As they hit that inflection point, again, going back here, we're talking about right here, in the nation of investors basically lightening their positions in the company. All right. So one other point to drive it home, here's the profitability over time. I want you to notice that if you look hard enough at this, we are basically talking about being at 6%, not 9%. So that's what I was patting myself on the back for a little bit. Keep in mind that prediction was made back here, right? And then one last point to make, the projected return on value does not care about the PE ratios. It's not part of the calculation. And you can see that coming out of that nasty situation in 2008, when Ken, again, was feverishly seeking investments, probably all-time best opportunity. And this is a fairly steady projected return on value for a retailer. And it's not bad now. Your thoughts, Ken?
Well, I agree with all that you're showing us, Mark, and that the sophistication of some of the thinking that's gone into these last 5 or 6 slides is the sophistication that's been lacking a little bit, I think, in the stock analysis that goes on sometimes by people that think they understand the stock selection guide. And in fact, they just scratched the surface of how useful that guide can be, because it's no more than a guide. It's not a black box.
Yeah, and I guess the point to really be made here is over the vast majority of those years on display here for earnings, the PE ratio listed in value line is NMF. It actually has a PE, which we would recognize as something that we can understand, in, I believe, only 3 of those 20 years. Chew on that. All right. I think that's all we got. We're running up close to an hour. Did want to remind everybody that we do archive these sessions, the bull sessions, the roundtables. They're archived at YouTube. You can just search on Manifest Investing. You will find it. If you can't find it, send me an email or Ken an email. We'll be happy to direct you to it. The 4 sessions from a Successful Investing 4 are posted, and people are checking things out. You can go and read my dramatically good analysis of emergent biosolutions at this one. And now that Matt has whet our appetite, maybe I need to go back and listen to what I said. I don't know now. But we did have some fun. And Ken, I don't want to speak for you, but boy, those 20 questions, which, by the way, we were kidding ourselves when we said 20. I think we got in 12, right?
Yeah, I think that's all yeah, we did cover 12. You're right.
Covered 12, but the 12 are pretty good in my opinion. Really a pleasant adventure with you and Cy.
Well, and if we go at this kind of conference again, Mark, that's worth a double session. You know, it's worth a session with a break and then a continuation, because the questions were coming fast and furious from our audience, and we were just getting into the whole rhythm of things when we had to quit.
All right. So check those out if you'd like. Again, if you go to the page and you like what you see, if you subscribe or join, I'm not sure what it says in the little red box, you will be alerted anytime we post fresh content to the YouTube page. And then, Ken, this one's for you. I had actually 3 emails from people asking me to explain the mitten and how it applies to where Ken lives in Michigan. So I thought I would just turn this over to you.
Okay, well, look at the left-hand mitten. That's the lower one right there. And then look at the thumb, and then go down to the western base of the thumb of the mitten, and then go inland about 30 miles, and there's my home. We're near a little tourist town called Frankenmuth. We're near Saginaw, Michigan. We're near Flint, Michigan. We're out in the country, however, less than a block away from a lake on a little creek with all kinds of trees and a nice quiet neighborhood. I'm living right in the school district where I taught for 32 years, and we're quite happy. We like the snow. We like all the weather that comes our way. We complain about it a little bit, but we like it.
Mm-hmm.
So, but you can also see there's 2 mittens, and they're the same size, and that represents the upper and the lower peninsula. That's the same size peninsula on top as it is on the bottom down there.
The Mackinac Bridge is right here.
Yep.
And what was the other thing that people mentioned?
Where are Tequamanon Falls, just almost due north of the bridge, maybe 45 minutes to an hour.
Oh,
well,
Traverse City.
Traverse City is right there. Mark's pointing to Traverse City right there.
And all along this coast, this is the west coast of Michigan. I probably shouldn't give this secret away. There are beautiful white sand beaches, and you'd think you're on the ocean.
And it looks like the ocean. The only thing is, it doesn't taste like the ocean. You can buy a big sweatshirt almost anywhere along this coast, and it says Lake Michigan, unsalted for your pleasure. So.
All right. Enough indulging. We should get some royalties from Pure Michigan for this one, Ken. But
okay.
Enough people asked about the mitten thing that I thought we needed to spend a moment with it.
Let's stay on after we close down the process, because we have a few questions, Mark. Okay.
I will go ahead and shut off the recording. Thanks, everybody. See you next time.